Hello, everyone. Welcome to another episode of Dollars with Diz. In this episode, we're going to go through what are interest rates, and although there are many purchases in our life that require us to pay interest, this video we're going to focus solely on mortgage interest rates. The definition of an interest rate is just the cost of borrowing money. So when you borrow money from a bank or a friend, the interest rate tells you how much extra you have to pay back for that loan. So in this example on this slide, if you're borrowing $100 from a friend because you need it for some purpose or for some reason, and he says, that's fine, I'll let you borrow this $100, but you're gonna have to pay me 5% interest back. So that means when you pay him back, you have to pay them $105 instead of the initial 100 that you received. So the main gist of interest rates are that the higher the rate, the higher it is for you to borrow money because you have to pay them back more once you do make payments. So why is interest charged in general? In this scenario where you need a little over $100,000 to complete the purchase of your home and you don't have the funds to do so, the only way you're going to be able to get that property is if you can get a loan from a bank. You're asking yourself, why can't I just pay them back the same amount that they loaned me for the purchase? Well, there are kind of two reasons for that, and the quote in the middle here kind of explains both of them, that there's no such thing as a free lunch. Banks provide a service by lending you that money, and so they charge interest on that amount to pay for the work that they're doing for you. You know, it is an agreement between you and a bank, and without the bank there, you would be unable to purchase that property. So for the work that they're doing and providing you those funds, they want some compensation for that. Secondly, banks take on risk when lending money, so they expect to earn a little bit of profit on their return for that risk. You know, sometimes people are unable to make payments on that mortgage, and so there is risk on their side that they could lose the money that they loan to you. In return for taking on that risk, they're asking for a little bit more money back from you as interest. All right, now that we've talked a little bit about what interest rates are, I wanted to show you all how they're actually calculated when it comes to the mortgage that you take out. The first thing I want you to know is that when you see an interest rate related to a mortgage, you're seeing that number as an yearly figure, but you're actually making interest payments on a monthly basis for whatever amount is left of your loan. So in this example here, we're still using the figures from the previous slide, the $109,900. We're going to assume that this loan is a 30-year fixed mortgage at 2.5%. So how are we going to calculate exactly how much interest you're going to be making on your first payment? Well, we're going to follow this formula right below it, where we're going to take that 2.5%, right, because it's a yearly figure, and we're going to divide that by 12 to get a monthly amount. And then we're going to multiply that percentage by our $109,900. And so for our first payment, you know, this is the first payment right after you move in, the first payment to the lender, the total interest you're paying to them is $228.96. For your second payment, as you can see, the loan amount has changed because every payment that you make towards the lender, a portion of it goes to interest and a portion of it goes to the principal. So on your second payment, your second month in your new home, your total loan amount is now $109,694.71. So using the same criteria here, again, 30 years, fixed rate at 2.5%, we're going to do the same formula down below, which shows that we're going to take that 2.5%, that yearly figure for our mortgage, we're going to divide that by 12, and then we're going to multiply that by our current loan balance or our remaining principal balance that we owe the lender. Once we do that, we actually see that our interest being paid on that monthly payment goes down to $228.53. So what this is showing is, you know, between our first payment and our second payment, we're actually paying 43 cents less in interest because our loan balance has decreased. In these next couple slides, I'm going to go over kind of some direct language you might see in your loan documents and how that language relates to what we just talked about. So in this example, it is a fixed rate mortgage, and I've actually taken snips directly out of the loan agreement. And so we can read them here. So in the first one, 2.1, interest rates. Interest will be charged on unpaid principal until the full amount of principal has been paid. So again, that's saying you're going to pay interest on all of the principal of the loan until the end of that principal total is paid off. The second part says, provided there is no event of default, we can skip that. But the interest rate for the loan will be 5% per annum. which is just saying per year. So again, the number you see here is a yearly figure, but as we discussed in the previous slide, you're actually going to pay interest on a monthly basis. So that is actually explained in point 2 below. So it says, it's a 365-day year. So going into it, interest for each full calendar month during the term of this note will be calculated on the basis of 365 days per year, consisting of 12 months of 30 days each. So that's just kind of going into the idea that, yes, you have this 5% interest rate, which is an annual amount, but you're going to be making payments on a monthly basis, based on number 2 here, 2.6. So again, if we go into our formula from the previous slide, and I'm going to use the same numbers here so we can be consistent, starting again with that total unpaid mortgage amount of $109,900. Now we're using a 5% interest rate. So we're going to take that 5%, divided by 12. And now you can see in our first payment towards this mortgage, we're actually going to pay interest. The portion of that payment that is interest will be $457.92. Next example here, again, is a fixed rate mortgage. And I was, again, able to copy and paste this directly from the mortgage documents. It basically says the same things, right? So the first part up here in interest, it says interest will be charged on unpaid principal. So again, paying it on the outstanding balance of the loan until the full amount of principal has been paid. And I, as in the loan receiver, will pay interest at a yearly rate of 7.5%. Okay, so again, the rate that you see here is a yearly figure. In the section below, where it says payments, the first highlighted part says, I will pay principal and interest by making a payment every month. So again, you're going to make payments every month. And in this actual document, they actually provide you what your monthly payment will be. So at the bottom here, it says my monthly payment will be in the amount of $768.44. So again, going back to our example, using that $109,900, now we're at a 7.5% interest rate. So we're going to divide that by 12. And we're going to multiply it by the total mortgage amount. So in our first payment, the portion of our payment that is interest will be a total of $686.88. And in the snip below here, this actual agreement includes a schedule of all your payments. So you can double check our math. So you can see it says our payment amount is $768.44. The portion of that payment that goes to principal will be $81.56. And then the portion of that payment that goes to interest is matching our calculated amount above of $686.88. All right, in our last example here, we're going to switch to an adjustable rate mortgage. The only things that you'll notice that are different are just comments in blue versus what we've seen in the previous 2 examples. So again, looking at it, it does say the same thing as the last 2, again, with the blue being slightly different. So number 2, in interest, it says interest will be charged on unpaid principal until the full amount of principal has been paid. I will pay an interest rate at a yearly rate of 9.5%. So again, you're paying, that rate is yearly. In payments, it says I will pay principal and interest by making a payment every month. And then below, it actually tells you what your total payment will be of $916.53. The adjustable part of this is in blue, right, where it says in the first part, the interest rate I will pay will change in accordance to a different section of this document. So that's the difference between the fixed and adjustable, that the rate might change. And then again, in B, the blue statement says this amount may change. So our last example, again, using the same amount. For now, we're at 9.5%. So we're going to take that 9.5% divided by 12 and multiply it by our total first principal balance of $109,900. And so of that $916.53, $870.04 will actually be going to principal because of that 9.5% interest rate. So in summary, here are the 4 points I kind of want you to take away from this video. Number 1, interest rates are the cost of borrowing money. Number 2, they are a way for lenders to get compensated for their work and the risk taken when loaning out their funds. Number 3, any interest rate you see related to a mortgage, you're seeing as an annual figure. And number 4, you actually pay interest on a monthly basis based on the remaining amount of your loan. And I guess the biggest takeaway here is what I'm going to show you on the right, where the higher the rate, the higher the cost. And I don't know if you noticed, as we went through the presentation, we increased our interest rate every time. So in this table, you can see, as we start at from 2.5%, we're only paying around $230 on interest. And as we get to the last slide where we're paying 9.5%, we're going to pay $870 in interest. So you can see the difference between going from 2.5 to 9.5. And again, the higher the rate, the higher the cost for you as the borrower. That's it for this video. Thank you for watching. If you have any questions or feedback, please leave them in the comments below and we'll get back to you, and I'll talk to you again later.